Hey, everyone, and welcome to today's show on Wealth Strategy Secrets. Today, we're joined by Dan Hanford. Dan and his wife, Danae, along with their 4 children and a standard poodle, reside and work in Columbia, South Carolina. He's one of the managing partners with PassiveInvesting.com, which is a national passive real estate investing firm based in the Carolinas. He has led his real estate syndication company to acquire over 4,200 units with a portfolio valued at over 1 billion. That's right, 1 billion, with just over 1,750 active investors. Dan and his wife are also passive investors in 57 different passive real estate syndications, which comprises over 10,900 doors located in the Southeast primarily, across 17 different operators. Prior to getting started investing in real estate, Dan had an extensive background in starting multiple 7-figure businesses from scratch, including a large group of non-surgical orthopedic medical clinics located in South Carolina. And finally, Dan is also the founder of the Multifamily Investor Nation, where he provides free multifamily education to a nationwide group of over 40,000 members. He also has one of the most popular apartment investing podcasts on iTunes called Multifamily Investor Nation, where he only interviews active multifamily investors that have closed a deal in the last 12 months. Dan, my friend, welcome to the show.
Thanks, Dave. Appreciate you having me on and looking forward to the conversation today.
Yeah, for sure. Yeah, really grateful to have you here. I mean, as a strategic partner, but also in the perspective of, you as an investor yourself, right? And I really love your story. It resonates with me as an entrepreneur, and a lot of the folks on our show have been building businesses, trying to scale business, but we're also talking about, it's great to do capital creation, but how do you actually, protect and multiply your wealth as well? And I know, for you that journey started very early. So maybe you can just give a little background as to, how it all started for you.
Yeah, I mean, I would say where it all really started was when I got out of a chiropractic school. So I'm a chiropractor by trade. When I got out of chiropractic school, started my very first clinic, started working in it myself for the first, year to 2 years, 3 years. And one of the things that I found early on is that I was really kind of stuck in a job, even though I owned my own clinic, because I could only see so many patients an hour. So my income was capped. And whenever I wanted to go on vacation, I still had to pay my staff, still had to pay my overhead. And so I was kind of stuck because I never wanted to go on vacation because it cost too much money to pay for all this overhead, plus have to pay for the vacation. And so it was not a very good work-life balance, if you will. And so I learned quickly in the very beginning that I needed to hire people to be able to help support the business and allow me to be able to do the things that I wanted to do. And so I learned very quickly to become the CEO of my business and to hire great quality people. And I will say I'm not perfect when it comes to the hiring process, and one of the things that I have a mental block on, even today, I still struggle with this, and a lot of entrepreneurs do, is that I feel like I can do everything better than anybody else, right?
Yeah.
It's something that I just had to accept and say, yes, that is a flaw in my head, that I think that I can do everything better than everybody else. And I'll tell you, to this day, I still feel that way. And so even though I've definitely surprised myself and hired really great quality people, and they do things so much better than I think that I could have done them, but I still have that in my head. And so earlier on, it was very hard because I just didn't want to spend the money to be able to hire somebody to do something that I knew that I could just do myself, and I would do a better job at it. But what I found is that I was keeping myself from being able to grow because I was trying to do everything. And so I had to play a little kind of mental trick or mental game with my head, and basically just say, if I could hire somebody that can do it 80 to 85% as good as me, but it allows me to be freeing up my time to go work on something else, the vision, the growth, the strategic objectives of the company, then I can now start to scale. And so when I first started those clinic, the chiropractic clinic, where I really started seeing the hockey stick growth is when I learned to start to delegate things to people and hire good quality people. And in the beginning, when I was hiring, I was just trying to hire the cheapest people, right? And it really is not always the best to be able to hire the cheapest people. You want to make sure you have people that are great quality people, and they can support you very well, and they'll stay with you for a long time as long as you take care of your people, right? And so started to grow the clinics from one clinic to now we have four locations across South Carolina. I got one here in Columbia, South Carolina, which is where I live and work. And then I also have one in Greenville, South Carolina, Charleston, and then North Augusta, about 10 minutes from the Augusta National Golf Course down there. And all four clinics do really well. And that presented a problem for me where the clinics were all debt free. And so they were cash flowing very nicely. And when you cash flow very nicely, what do you have to do? You got to pay money, right? You got to pay, you got to pay Uncle Sam. Yeah. And so the taxes started to build up, and it was getting frustrating because we're working all year long and paying a huge amount of money and then taxes to the government. And so I had to figure out a way to, do what a lot of other people do, is invest in real estate to offset the income with depreciation, and allows us to reduce our taxable liability across the board. And that's really kind of what we did I stepped out of the day-to-day operations, promoted my COO to the CEO. I still maintain as the president. My wife and I still own the clinics 100%. But they are now being run solely by our group of team members. We have about 40 full-time people that work in that group, and nurse practitioners, medical assistants, medical doctors, that actually run the day-to-day operations. And it's interesting because when I first started, it was a chiropractic clinic. And then we kind of morphed it into a integrated clinic where it was an MD DC clinic. So there was a chiropractor and MD all under one roof. And then we moved and pivoted away from chiropractic completely to focus on the non-surgical orthopedics and sports medicine component. A lot of it was because there were no other providers in our area that were providing this kind of a specialty service where we're doing prolotherapy, PRP, stem cell procedures for orthopedic conditions, and even just some standard basic injection procedures for people who have knee pain and different types of arthritic conditions. And so it really was an opportunity for me to be able to grow and expand in South Carolina, to be able to help people that, would normally just get pushed off to surgery. We can help them avoid that surgical route and provide them some alternative options. And so we grew from that one clinic to the 4 clinics, and we stepped out of it because of the tax benefits of investing in real estate. And then that's where I started to invest passively first. And so a couple of projects, then hired a mentor, started to partner with a couple of groups first, and then went out on our own and started acquiring properties, and joined up with Danny and Brandon and formed passiveinvesting.com. And that was back in 2018. And we've been on a very fast track of growth, which is great. We've acquired just over 1.2 billion in assets, and we've exited several projects last year. And so right now our holdings is just over $1 billion in assets right now. But it's been quite interesting to kind of see how we've come from, starting the clinics and seeing that growth, to taking a lot of the things we learned from those businesses and moving them into this private equity real estate group, and being able to raise the kind of money that we've had from our 1,700 plus investors, and getting over $1 billion portfolio.
Yeah, it's such an awesome story, Dan, and to watch the growth, firsthand as a partner with you guys. I mean, it's just been really awesome. And I can really relate. And I think, we have a lot of entrepreneurs in our community. And I think I mentioned to you, I'm in that strategic coach program. And one of the things that they talk about, right from the Who Not How book, but one of the things they talk about is being a rugged individual is what they call it as an entrepreneur. And it is exactly that. Is we're wired to think we can do everything faster, better, cheaper than everyone else. So scaling a business is really, really hard. And having done it, myself for a couple of different companies, try to build companies, my hat is really off to you, because, trying to scale is not easy. And that's why, most businesses actually don't do it successfully. But when you can learn the power of building a team, and you did that well in the clinics, and now that, translated into this latest business. So it's really impressive to see. And I think it's really inspirational as well, Dan, for a lot of other entrepreneurs, not only in the space of real estate, but just other entrepreneurs, how quickly you've scaled. So that's awesome. So tell us a little bit about, what would you say is your definition of wealth building for you at this point?
Yeah. Well, it's interesting because, at this point, yes, our wealth is growing from what we're doing with the private equity real estate. We still have our income coming in from the clinics. But, for me, one of the things that gets me excited is, yes, building our own wealth, but also seeing other people building their wealth alongside us, which is really exciting. So when we talk about wealth building, wealth can be a wealth of knowledge, right? It can be a wealth of money, monetary aspects. It can be a wealth of experiences. And it can also be a wealth of providing other people with experiences and the ability to grow their own monetary wealth, if you will. And so for me, that's kind of what I like to do is provide a lot of different experiences for other people. And that's kind of how I build, I guess, my wealth up is being able to provide experiences for other people, because you could buy somebody a widget, but they might use it for a little bit of time and throw it away. But you can't take experiences away from somebody. Like, they're never going to forget a trip somewhere or something that you did for them or some sort of an experience, right? It's a memory. They can't take it away. And so that's one of the biggest things that I like to do from a wealth building perspective.
Yeah, I really love that, Dan. And it's something I think we both definitely share. And, why we've been partnering on a lot of deals is that having that philosophy, right? Because in this space in private equity, right, there's a lot of institutional capital flowing around. And, when you get into that institutional realm, you take away the opportunity for the individual investor to participate in these deals. But you've always been consistent around, trying to help these individual investors, be able to build their wealth, which I think is really awesome, right? Because most people just think the only place to invest is stocks, bonds, and mutual funds.
Yeah, no, the institutional route is definitely something we've looked at and considered, but it's one of those things where we have not taken on any institutional capital at this point. And even after doing some of our research, we don't necessarily even want to take any of the institutional capital because they're usually harder to play with. And like you said, it's great for us to be able to provide all these different opportunities to really take away these types of assets from the institutional space and bring them to the everyday, a high net worth investor that can invest their wealth alongside us and grow this together. And all the equity we've raised so far has not come from institutional at all. It's all been just private, high net worth individuals and groups that have companies that are high net worth that have invested alongside us in these different projects.
Yeah. So tell me something as well. As an investor, you and your wife are invested across 57 different syndications. And sometimes, we have investors just trying to get their arms around, managing a couple. So do you have a dashboard that you use to manage these assets, to see them? Do you have any particular software or methodologies that you use to kind of track everything and meet your goals?
So it's actually 64 now. Since I sent you that bio, we've actually increased it a little bit. But yeah, so nice. we actually have a spreadsheet, just an Excel spreadsheet that my wife is the one who handles most of our kind of personal finances and working with our personal accountant to do things at the end of the year. And so I have a spreadsheet so that whenever we go out and invest in something, we'll go to that spreadsheet and we'll add it to the line item and talk. And it has different things on there about when we invested into it, when it closed, what the projected exit is, what's the monthly cash flows, quarterly cash flows, yearly cash flows that are projected off of it, and what we can expect. And so we can kind of see what the projections were, what the actuals were when it goes full cycle. And we're seeing quite a few of those last year and even this year going full cycle. We actually had 5 of them just this month that I've actually sold, and we're completing those investments, if you will. But we do have a dashboard. I don't think I've ever actually called it the dashboard, but that's basically what it is a dashboard in Excel that we just put together with some columns and rows. And as we do an investment, we add it to that spreadsheet.
Yeah, that makes sense. And are you employing any tax strategies, specifically right now? So like, let's say you've had a couple of exits, the businesses are doing well, right? So how are you really utilizing, particular tax strategies right now?
Yeah. So, right now, because I'm qualified as a real estate professional in the real estate professional status, the depreciation that we get off of the investments will offset all of our income, right? My income, my wife's income, the clinic income, the income off the properties, even when they're sold. And so our goal, whenever we, have a property that goes full cycle, is either to 1031 exchange that with that group into the next asset, or we'll cash out and we'll move that money into another investment so we can then continue to grow our portfolio and grow our nest egg, right? And that's exactly what we do with the cash flows. Like the cash flows right now, every month that come in, we take those and we put them into another investment to allow that to continue to grow and continue to snowball. And that's actually how you really start to grow a portfolio is you take those cash flows and you immediately just reinvest them, right, into a different type of an investment. And so that's really what we're trying to do is to try to grow it from that perspective. But from a tax perspective, the depreciation offsets our income at this point. And so that's really what we're doing from a tax perspective, because there's a lot of other things that we could do and that we are knowledgeable on, as far as, writing off things here, or writing off things there, or doing different, strategies. But for the size of our portfolio, it's kind of smaller, kind of peanut type stuff, if you will. And it doesn't really make sense because all of our depreciation is offsetting all of our income. So we don't necessarily have to keep track of a lot of those different smaller strategies because of the depreciation that we get that offsets it, because we're classified as a real estate professional.
Yeah, absolutely. So it's really a rinse and repeat strategy for you. So anytime you have a liquidity event, you have additional capital flowing in, then you're just taking that capital, reinvesting it, and then getting that depreciation off of the new assets.
Correct.
Yeah, correct. And so in terms of your, you don't have to answer this if you don't want to, but your tax rate, generally speaking, what have you been able with this strategy to get your taxes down to?
Well, it's zero. So we haven't paid federal income tax for quite some time now, because the depreciation offsets all of our income. If we weren't, we would be in the top tier tax bracket, paying 37 to 40%, depending on the year, I guess, if you will. But for us, because of the depreciation is offsetting all of our income, we're effectively paying zero federal income tax.
It's really awesome, Dan. And I'm sure, you've had so many conversations with investors as well, but, really the power of depreciation and tax is so huge. Even if you separate it from the investment itself, just think about if you dropped your taxes 10, 20, 30%, how much more capital you have in that year to continue to buy assets, right? And then you keep doing that. And the same thing if you have a liquidity event. We have a lot of entrepreneurs selling businesses, right? And so it's how to offset, all of those capital gains taxes. But that is completely the goal, is to get to tax zero, and investing in real estate and some of these, alternative assets can definitely get you there. So,
well, and one of the biggest benefits of using the depreciation as well is that, you get to kind of change the classification of your income. So instead of paying like ordinary income tax, you now can pay just the capital gains tax instead. So that your tax rate actually changes if you're in an investment that is providing you some capital gains. Now your tax rate's going down to say, 20, 25% versus when you're in the top tier tax bracket at, 37, 40%. And when you do that, you can kind of offset those taxes and kind of defer them for quite some time. And hopefully you can do it all the way until you die. And then when it passes over to your children, then it resets, the basis resets at that point, so that you effectively are paying, your family's effectively paying zero in capital gains or recapture.
Yeah, exactly. You get a stepped up basis, and ideally they don't change that. Congress doesn't decide to change any of that, but
they may, but who knows?
Yeah, exactly. But that is really, a great strategy. And again, I think that's aspirational for investors to try to realize that there is a place you could get to, which is tax-free zero. And you can even do that without being a real estate professional. Right. And we've had other people who, once they figured out that real estate professional status, they've done things where they've gotten their spouse to get it. because they can't qualify because they have a W-2 job, but, it just requires 750 hours a year. So maybe, your spouse can be, let's say managing an Airbnb, they can be managing these passive investments that you have to qualify so that you can really offset your active income with those losses as well.
That's the key thing is as long as you're married filing jointly, as long as one of you is classified as a real estate professional, you can offset both incomes with the depreciation.
Yeah.
Now, absolutely. I will say that neither Dave or myself, at least I know for myself, I'm not a tax professional. So make sure you check with your CPA and stuff like that. I didn't stay at a Holiday Inn Express last night, but I am buying one out of Hilton Head.
Yeah, it's so funny because I've actually stayed there myself. I know exactly where that one is. But yeah, great point on the disclosure. Please seek advice from your CPA. But I think it is. What's interesting, Dan, right, is that, so many of us were raised with conventional wisdom thinking, right? And it's this $30 trillion financial services industry that's pounding into our heads. Well, and put your money in a 401k, defer taxes is the smartest thing you could do. Right. And that's what everyone is told. But when you start to think about it, it's like, okay, well, why would I defer my taxes and then pay at ordinary income tax rates when you take it out, when you have the least amount of deductions and you need the most amount of capital in the future? The other thing I think people don't realize is that you're probably, I can't predict the future, but the one thing I'm quite sure of is taxes are likely going to be higher in the future than they are today. Right. So why defer those, taxes, right? Start putting, that depreciation to work today.
Yeah, agreed.
Any other strategies that you can share with the investors, because again, from your perspective, you've just executed so well and not only on the business and, we can jump into, where the business is headed and everything in a minute, but really just an investor. You've executed so well as an investor. So any other strategies that has really helped to, again, protect and multiply your wealth that you could share with listeners?
Yeah. I think a lot of the listeners probably have some form of retirement account, whether it be a 401k or an IRA. And it's interesting because a lot of our investors didn't even know that they could tap into that retirement account to be able to invest in these types of different projects that are in real estate, right? And so you can actually take your retirement account, whether it's an IRA or a 401k, and you can actually self-direct it, take it away from the stock market and the equities and the volatility, and put it into a more safe and secure and risk mitigated investment like real estate, right? And put it into a self-storage asset or apartment complex or whatever you're wanting to put it in, and you can passively invest it in something else. Now you can't use those dollars to invest in a project that you control. There are some exclusions there, or even that your family controls, an extended family, but you can do that with somebody else, right? So you can invest alongside another operator or something like that to grow your wealth. And a lot of times people think it's too complicated, and it's actually not. It's fairly simple. So if you have a 401k or something like that, and you're concerned about continuing to invest in custodians or 401k custodians, and they're self-directed groups, there's like Quest Trust, there's Advanta IRA, there's New View, New Trust, American IRA. There's several different groups out there that all they do is manage these self-directed retirement accounts, and you can direct that. And my wife and I have one of those ourselves, and we've actually been able to grow that 7-8 times since we started investing it only about 3 or 4 years ago. And it's because we've just been taking that money, reinvesting it, and then just kind of rolling it in and kind of allowing it to snowball.
Yeah, no, excellent point. IRA is really a key move in terms of really asset repositioning is what I like to call it, because a lot of times investors will get excited about the concept of investing in multifamily or some of these different assets, but they say, I don't really have the minimum, lying around to invest. So tapping into that and repositioning it is really a great strategy. So Dan, let's transition into passiveinvesting.com, the business today. You guys, again, just on fire with, acquisitions and, seeing some really, great returns. And I think the asset management and operational efficiencies that you're driving with the team is just top notch, which is, has been really great for our investor community. So tell us a little bit about the business today, what you're seeing today in this environment and things you want to share.
Sure. So one of the things that we wanted to do from the very beginning is not pigeonhole ourselves into just one asset class. We wanted to make sure we had an opportunity to branch out into some additional kind of alternative asset classes with our group. And so instead of, in the beginning calling our group multifamily passiveinvesting.com or apartment passiveinvesting.com, because our primary holdings from the very beginning has been buying large apartment complexes. We've bought apartment complexes as small as 3 or 4 million in the very beginning, upwards to one that we just closed a couple months ago at 109 million, right? And so we didn't want to always be stuck with just the apartment complexes. And so last year we actually branched out and started to acquire self-storage facilities. And so we actually have right at, I think close to about 95 million in self-storage assets now. And we also started to do some research about probably 2 years ago, even before self-storage, looking into the hotel and hospitality space. Obviously COVID put a halt on that for us for the last 2 years because of the volatility in the hospitality market with the shutdowns and stuff like that. But we are now acquiring hotel assets. We have one located, like we were talking about earlier, down in Hilton Head, the Holiday Inn Express down there. And then we also are we're acquiring express car washes. So there's 4 asset classes right now that we're in. It's apartment complexes, self-storage facilities, hotels or hospitality, whether it be full service or select service hotels, and then also express car washes. And what's nice about that is if you look about across the board, each one of those different asset classes provides a different level of risk and also a different level of mitigation of potential, recessions down the road. And it also allows us to kind of pivot in different areas too. So for example, on the apartment complexes, they're usually going to be 12-month leases. So 12-month rentals that you're going to have. And so when you would try to shift and turn an apartment complex, it can take a little bit of a time when the market starts to shift, about 12 months, because that's how long it takes to turn over all the leases and either increase or decrease the rates depending on the market status, right? And so with self-storage facilities, it's a 30-day rental, right? Because they're usually month to month. So every 30 days, you can actually shift and change and increase your rates to be able to either increase or decrease them based on the market conditions. So you can pivot a lot faster with the self-storage facilities. Well, when you look at hotels, those are 24-hour rentals, right? So they're every day somebody comes in, you could change the rates up or down to be able to make sure that you keep your property full. And then of course you go to the express car washes and it's like 5 minutes, right? So they're basically paying for the rental of that tunnel that they're going to be taking their car wash through for 5 minutes or less. And but you can change the rates of that up or down to be able to mitigate the market conditions. And the other thing that I like about the asset classes that we're in is that the expenses go up and down based on the demand of that business, right? So the more you have, more cars you're washing, the more expenses you're going to have. And so if you start to have some sort of a recession or whatever, and your volume goes down, well, your expenses go down in the same direction, right? Because if you're not washing as many cars, and your expenses are not going to stay the same because you're not using as many chemicals, you're not using as much water, you're not going to need to have as much staff on site. And so there's a lot of things like that from these different asset classes that provide a lot of recession resilience to them. And so that's one of the things that we like about it is to have the diversification in the portfolio and to have these different assets. And I will say that, multifamily is still our core holdings and it will continue to still be that way. But right now, given the current market conditions, especially with the capital markets, with the debt, it's so so much different than last year that it's really hard to make a lot of the numbers make sense. Even though we've still been able to find some assets and acquire them, we're underwriting hundreds and hundreds of deals before we find one that actually gets awarded to us. And it's been very, very challenging this year. So it's been nice to be able to have some additional asset classes and diversification to be able to acquire some other assets that provide great consistent cash flows with some nice pops on the back ends that can give us 15, 20, 25% returns.
Yeah, absolutely. And do you have a particular strike zone of, asset classes that you're looking at that kind of fall into your investment thesis?
Yeah, well, those four, of course, obviously fall into our thesis because we want to make sure we find asset classes that are recession resilient, have cash flow, and have pops on the back end, right? And so that's one of the things that we have to make sure we do is have those core things. And some of the additional asset classes that we are considering down the road, and it won't likely be this year because we do have a lot of things on our plate right now from a growth perspective that we're working on, but one of the asset classes is medical office buildings, right? Because medical is a recession resilient business and will always be there. And so acquiring and buying buildings that are medical office buildings. And we're not talking about like smaller, like, 2,000 or 3,000 square foot buildings. We're talking about, 10, 20, 30,000 square foot medical office buildings that have, diversification of different professions or specialties, if you will, and medicine that provide diversification in that medical office building. So that's an asset class we're looking at. We're also looking at some industrial spaces and industrial at the industrial building asset class, whether it be warehouse, manufacturing, light industrial, that kind of thing. And so right now, we're staying core. We're staying focused on these four that we have. What we've done as we've continued to grow, so we don't take our focus off of one asset class, and also making sure we manage and watch that investment for our investors. We are building out like what we call different business units and a different team around each one of these different asset classes to make sure that we can continue to grow, and also that so we don't take our eye off of the investments that we already have in place for our investors.
Yeah, that was just going to be my next question, right? Is that I would say, okay, you guys have performed well on the multifamily side, but, let's take one of these other, verticals like car washes, right? What makes you guys think that you can compete in the market? How do you have intellectual property, different insights into that business that makes you think, you're going to hit the same metrics, right? How are you able to do that?
Well, with the express car wash space, it's a very fractionalized space. And what I mean by that is that there's not a lot of like large institutional players in the space. There are a few, but most of the express car washes, I would say 93% or higher, probably closer to 95% of the express car washes are owned by smaller mom and pop operators, where they're going to build, 1, 2, 3, maybe 4 or 5 locations, and then their capital's tapped out, right? And so one of the things that they do though is they run it like a smaller mom and pop operation. You can go to one location and get a different level of service than another location, right? And so what we're trying to do in the space is trying to institutionalize it. And when I say institutionalize it, I'm not saying bringing in institutional money. I'm saying creating it as more, developing it and developing procedures and processes and systematizing things so that when you go to one location, you get the exact same service as if you go to another location. It's kind of like with Chick-fil-A, right? You go to a Chick-fil-A in California, it's the exact same experience and quality of food and the same chicken sandwich that you get when you're in Columbia, South Carolina. It's a consistent, predictable product. And that's what we're trying to do, is make sure we can train our team and train our staff to have these systems and procedures and processes in place to systematize things. And we're also trying to make sure that we can transition the stigma around working at a car wash from being a kind of, low level job to being a better quality job. Because when we've taken over some of these assets, there are people that are working there that are getting $7-8 an hour. And we're trying to figure out how they can live off of $7 or $8 an hour, right? And so there's so much cash flow that gets spun off of these businesses that these owners should be able to take care of their team, right? And they're basically just trying to hire people at $7 or $8 an hour instead of trying to say, hey, let me hire some people and pay them really good quality wages so that they can stick with us a long time and grow with us and expand it. So when we took over some of these car washes, we said, We're not going to be paying $7, $8 an hour. We're going to immediately bring those people up to 12, 13, 14, 15, even $20 an hour in some of these markets and really pay them well, give them benefits that they're not used to. And now we can start to attract a great quality people from other car wash operators that they want to come work for our group, right? And so because there's so much cash flow that's available on these assets, we have the ability to make sure we take care of our team, can grow this together, and be able to have a nice exit on the back end when we sell.
Awesome. Love it, Dan. And, and I think that's something that's, maybe understated here, but if listeners caught that, right, it's also really the way you're running your businesses. It's all about creating impact. So not only with your investors, but with your teams, also in the communities, right, that you're in. And I think that creates a unique opportunity for you to do that. And it's very powerful. Tell me also from that integration perspective, are you looking at vertical integration as well with these businesses where, so again, like let's say you're sourcing, chemicals or whatever on the car wash side, are you able to, start getting bulk discounting and things like that if you're managing that across multiple, different facilities versus just a few?
So yes, that is correct. And, as far as vertical integration, when it comes to like property management, we primarily lean on third-party property management for the apartments, the hotels, and the self-storage. The challenge with the express car washes is there is no third-party property management company that you can call up and say, hey, I want you to manage my car wash. Right. We have actually vertically integrated in that space, and we have started our own property management company for the express car wash space, and have already built out a team for that, consisting of the finance team and the vice president or the director of operations, if you will, there, and our regional managers and the on-site managers and all the on-site staff. So there's been a lot of work in the back end that we've had to do to be able to create that, to be able to have the benefits of having a quasi third-party management company being able to manage the assets. But that management company is only managing our assets, and that's it. So we're not looking at trying to bring on some of the third-party companies. But when it comes to supplies and chemicals, yes, because of our economies of scale and having multiple locations, our goal this year will be to have just over 50 locations with the express car washes. And so when you have 50 locations, it definitely allows you to have some clout and some ability to negotiate for some better pricing on chemicals. And even from a chemical perspective, we've actually are in talks with some chemical engineers to be able to hire them on to be able to create our own chemicals, to be able to even allow us to have even better pricing on our chemicals. And that would be a whole nother business unit that we could actually create and be able to expand and scale that side of things as well.
Wow. That's awesome, Dan. So if you could give just one piece of advice to our listeners about their wealth trajectory, what would it be?
Well, the biggest thing I would say is, just like in business, if you can't measure it, you can't manage it. So we talked about that dashboard that we were talking about with my LP and my passive investments. You need to make sure that you are measuring the success of your investments so you can make sure that you can manage it properly.
Yeah, absolutely. So Dan, it's been great having you on the show today. I know you guys have a ton of things going on in the business, especially the MFIN conference coming up June 23rd through June 25th. Would you like to have any comments about that? Talk to folks about that?
Sure. Yeah. So, of course, glad to have you joining us there at that event. Going to be a great event. We have 3 celebrity speakers that are coming. It's going to be Shaquille O'Neal, Barbara Corcoran, and Jocko Willink. So if you know any of those 3 names, you can go there and kind of hear them speak and have the opportunity to rub shoulders with them a little bit there. Actually, Jocko is going to be joining us at our VIP party on Friday night. So if you want to upgrade to a VIP ticket or something like that, you can join us there. You can find out more information by just going to mfincon.com. We're going to have over 60 high-level multifamily speakers that are going to be there. Our goal is to get over 800 attendees there, and so we're excited about it. And I think you have a promo code, don't we?
We do have a promo code. So if any of our listeners want to attend, the promo code is just Pantheon, which you'll get a nice discount for that. But would love to see folks out there in person. I'm really excited about this conference coming up. I think it's going to be awesome. I'm glad you're putting it together in person as well, because I know, you've done the online one for years, which has, been tremendous as well. But, there's just nothing like being in person.
Yeah, no, it's one of those things that we have honestly resisted doing in person just because it's a lot of work. But we felt like now was the right time because we have built up a large enough audience that we feel like we have a good group of people that we can get to the event. We have a lot of great high level speakers that are going to be there in the multifamily space. We have, Jake and Gino, we have Mark and Tamil Kinney. We have Rod Cleeth that's going to be there. We have Michael Blanc. So there's a lot of like major players in the space, of course, including you and me and our team and everybody like that. It's going to be great to be able to be there in person and be able to meet some people that even over the last 2 years that we've not been getting together, that we can finally get together and kind of rub shoulders with each other, shake hands, meet some of our investors that we haven't even met yet.
Yeah, awesome. And it's going to be at a great location as well. Great time of year, right? And nice and warm in Charlotte. So really encourage folks, if they want to learn more, have the opportunity to meet Dan, myself, lots of other folks down there. Please try to clear your calendar because it's going to be a great one.
Absolutely.
Anything else, Dan, in terms of that you want to leave with investors, ways for people to get in touch or follow you or keep apprised of what you're up to?
Sure. Yeah. So there's two ways you can do that. You can go to linkwithdan.com. Linkwithdan.com will just bring you straight over to my LinkedIn profile. So you can connect with me there and follow me there. And then you can also go to our website, passiveinvesting.com, and then check some more information, different offerings that we have available. And then if you want to join us on some of our future opportunities, then on the top right-hand corner of that page is a big blue button that says join the Passive Investor Club. You can join us there and look forward to having you partner alongside us in some of our future properties.
Awesome. Dan, thanks so much for coming on the show today. We'll link everything in the show notes, but really appreciate it.
Thanks, Dave.